All right. So, are there any questions that you have? You have to unmute yourself to ask questions, but any questions? If not, all right. So, what I'm going to do is basically go into this screen sharing. Now, Monday, either Zoom went down or my internet went down. I'm not sure. So, just bear with me. Hopefully, the last two classes have worked fine, but we'll see. So, if you remember, this was chapter 2 questions. And we got into this idea, and the only thing I want to go over is the margin transactions and short sales. The other's kind of self-explanatory. But if you remember, if we wanted to buy 100 shares of M&O using a 60% margin, what we were doing was borrowing some money and using some of our own money. Okay? Now, the 60% margin, we got to figure out what the equation is. The percent margin was calculated as the equity position divided by the market value of the transaction. So buying on margin was pretty easy. If we've got an initial margin, remember the SEC sets this up. The minimum initial margin is 50%, but a brokerage can imply a higher initial margin. So here we're using an initial margin of 60%, and we're wanting to buy 100 shares of M&O at $70. So if we look at that, we can figure out that the equity position is 60% of 7,000. So what's 60% of 7,000? Well, if we solve for E is equal to 4,200. Okay. So what does that mean? That means in a $7,000 transaction, if we have 100 shares of stock, and right now they're worth $70, and our equity position, excuse me, is 4,200, then that means by default we borrowed 2,800. So the initial margin is basically just used to figure out how much you're going to need to borrow when you're buying stocks on margin. And buying on margin creates a levered transaction. All right, so the first question basically says, hey, how much money did you have to invest today? Well, you had to put up 4,200. And how much did you borrow? You borrowed 28. And that got you $7,000 to purchase 100 shares of stock. Okay. So then the next question looks at what price will trigger a margin call. And here, the margin call occurs when something bad has happened. Okay. So if you look at it, remember, the assets are the shares of stock that you purchased. What can change every day is the price. So had you bought these before spring break, or 2 weeks before spring break, and all of a sudden the world pandemic came about and stock prices are down, the share prices can plummet pretty quickly. So in order to protect themselves against just such an occurrence as we saw over the last couple of weeks with a lot of volatility, the brokerage companies will put in a maintenance margin. The maintenance margin is make sure, hey, when the price falls below a certain amount, you're going to have to do something if you're wanting to buy these stocks on margin. You're going to face what's called a margin call, which means you're either going to have to put up more capital or we're going to liquidate the position. And so one of the things we're looking at is to try to figure out what price will trigger a margin call. Okay. So now we've got to figure out, though, we know what the initial equity is. Okay. The borrowed amount is going to stay the same. That's the liability. The borrowed amount was $2,800. Okay. Now, what's going to change, though, is as the price changes, so does your equity position. Okay. And that pretty much determines how you make or lose money. Okay. If the price rises, if it went to, let's say it went to $90, then all of a sudden you've got assets that are worth 9,000. You only borrowed 28 against it. And so you've got a nice hefty equity position. If the stock falls, let's say it falls to $60, you only have 6,000 worth of assets and you borrowed 2,800 against it. So you've got to figure out what happens to your equity position. Well, it's going to drop to like 3,200. So what they want to figure out is when will that drop to where your percent margin is now at 30%. Since we don't really know what the equity is, and the equity is dependent on assets minus liabilities, then we just go ahead and write in assets minus liabilities here, and that is equal to equity. Because after all, assets equal liability plus equity. So equity would be equal to assets minus liabilities. So again, we've got the same equity here as we do down here. We've just written it a little bit differently. So this is equal to 100p minus 2,800 all over 100 p star. This, though, is the market value of the transaction in the denominator. This in the numerator is still 100 p star, but it's really assets minus liabilities. Okay, and we want to see when that's all equal to 30%. So in order to solve for that, just multiply this through. We get 30 p star is equal to 100 p star minus 2,800. Bring this over here. 2,800 is equal to 100 p star minus 30 p star. 2,800 is equal to 70 p star. P star should be equal to $40. Make some more room down below. Okay. All right, so now we found the price that would trigger a margin call. In fact, you can go back and look. We could go back and recheck it. The percent margin is equal to the equity position. Now the equity position has dropped because the price has dropped down to $40. So the equity position at $40 is 4,000 minus 2,800, which is $1,800. Or excuse me, $1,200. Okay. So the equity position would be $1,200, and the market value of the transaction is 100 shares at 40. And we can see that 1,200 divided by 4,000 is equal to 30%. So the price that's going to trigger a margin call is 40 bucks. So if the stock falls down to $40, that's the price that's going to trigger the margin call. Excuse me. The last thing we have to figure out is what is the overall rate of return if you sell the stock and the stock goes up to 77 or it drops to 65. Okay. We're also going to assume a margin call rate at 8%. So what does that mean? We go back to the beginning of our problem. And we said, hey, remember we bought shares when they were $70 a piece, and we had to put up 4,200. So on day 0, we put up 4,200 to buy 100 shares of stock, but we also borrowed $2,800. Now, we're going to look and see, for instance, 6 months later, the stock price is at 77. So if we look 6 months later, okay, we want to figure out what our equity position is 6 months later when the stock is trading at $77. So it went from 70 to 77. And what we borrowed was $2,800 plus interest. Now, how much interest do we owe? That's what we need to figure out. So we know the value of the assets is $7,700 if the stock is trading at $77. We borrowed $2,800. We've got to figure out the interest. Well, if we're borrowing money at, if we're borrowing money at 8% a year, then after 6 months, we basically owe essentially half of that. There's 2 6-month periods in a year. So we're going to owe $2,800 plus the interest on that. And there's 6 out of 12 months. So 2,800 times the 4% plus the 2,800 puts us at $2,912, or basically about $112 worth of interest, which is 4% of 2,800. So we owe $2,912, but we've got assets worth $7,700. That means our equity position would be $4,788. So if we started at 4,200, the initial equity position, and 6 months later, our equity position's at 4,788. And we want to express this as a percentage return. Ending minus beginning over beginning is the percentage return. We can see that we're at 14%. So the reason margin worked here is because the stock went up 10%, but we had borrowed some money, so we created some leverage, but we had to pay interest on that at 4%. So the stock went up 10%, but we ended up with a holding period return of around 14%. And that's how margin works. It magnifies gains, okay, but not as much as you'd think because of the interest on the loan. The problem is it also magnifies losses. So let's go back and look. Remember, we started with an initial equity position of 4,200. And now what happens if the stock over 6 months, instead of going up to 77, what if it drops to 65? So if we go from $77 down to 65, so here we were climbing along at 77 and drops down here to 65, what happens? Okay. 6 months later. Okay. Well, let's look at our equity position after 6 months. We have 100 shares of stock for $65. So that's $6,500 in assets. We owe $2,800 plus interest. We already know that over 6 months that interest is $112. So we owe, in terms of a liability, $2,912. Now what's going to happen to our equity position at the end of 6 months? Well, since our assets are only worth $6,500, we owe the $2,800 plus interest. It's going to put our equity position at $3,588. Assets equal liability plus equity. Solve for equity. So if we started at 4,200 and ended up at 3,588, our percentage return is not good. Negative 14.6%. Okay. So we went from $70. Here we only dropped $5 and we lost 14.6%. Here it went up $7 and we gained 14%. That's because when the stock drops, not only you get the leverage part of the magnification of the loss, but you also get the interest on the loan as well. So we went from 70 initially down to 65. So I'll look here. We went from $70 down to 65. It went down $5, and we had a magnified loss. Whoops, that looks weird. I don't know what happened there. Weird thing on the screen. Let's see if I can erase that. There we go. All right. So here we were at 70. If it drops down to 65, we lose 14.6%. All right, let me stop the screen sharing here. All right, any questions on buying on margin? You have to unmute yourself and ask a question. All right, no questions. Let's look at the short selling. Remember, short selling was a little bit different. Short selling involves borrowing a security, and you're hearing a lot about this now. In fact, people are trying to limit short sales, or there's some talk about it. It calls for borrowing money today, or excuse me, borrowing shares of stock today from someone else, selling them, keeping the money, and then having to cover your position later on. And what you're really hoping for is the stock price to go down, at which point in time you can buy it back at a lower price. So if you want to short sell 100 shares using a 60% margin, essentially what you're going to do is borrow 100 shares of stock, sell them today, and if the stock is currently at $40, you will generate $4,000 worth of cash. In fact, that's the part of your assets. The liability, of course, is you borrowed 100 shares and you're going to have to rebuy them or cover your short position at some point in time in the future. Okay? Now, in addition to the $4,000 cash, the broker is going to want to make sure that there's additional money in case the position works against you. That is, in case the share price goes up. So they're going to require you to put down a margin deposit. Now, how much is that margin deposit? That margin deposit depends on the initial margin, which again is a minimum of 50%, but can be more than that. In this case, we've got an initial margin of 60%. Our formula doesn't change. Percent margin is equal to the equity position divided by the market value of the transaction. Since we want to set this up at 60% and the market value of the transactions for 100 shares at $40, then 100 shares at $40 is $4,000 multiplied by 0.6 means that our equity position is 2,400. Just solve for E. Okay. All right. Now, that's actually the money that we have to deposit is the $2,400. So actually, all told, there's $6,400 available to repurchase the 100 shares of stock. So that gives us a little cushion in terms of what we're able to repurchase. Okay. Now, so how much did you have to invest today? You had to invest $2,400. What price will trigger a margin call? We'll work through the same math. Well, if the maintenance margin is 30%, we now have to figure out, again, equity divided by the market value of the transaction. But now the price is changing. Okay? So if the price changes, what's going to happen to your equity position? Well, here the price change is going to affect the liability. The asset remains constant at 6,400, the 4,000 plus the 2,400. So the asset remains constant at 6,400. The liability is what we don't know. What does it cost to repurchase 100 shares of stock? It depends on the price. And the market value of the transaction is also 100 P star. Now we've got to figure out .30 is equal to 6,400 minus 100 P star over 100 P star. 30 P star is equal to 6,400 minus 100 P star. 130 P star is equal to 6,400. P star is equal to 6,400 divided by 130. P star is 49.23. At this point in time, you want to go back and double check to make sure. Remember, margin calls are bad. So a stock that was at 40 is going to need to go up in order for bad things to happen. And if in fact it did go up, and we're showing it went up to 49.23 before the margin call, then that at least makes sense. Okay. Something bad's happened. Buying on margin, the bad thing that happens is the stock price goes down. Short selling, the bad thing happens is the stock price goes up. So how do you make money in a short sale? You wait for the price to drop. Now, I don't know what's going to happen when I do this. Unfortunately, I'm running out of room. But we'll try to, not going to be the greatest whiteboard presentation. All right, should have made more room down below. So now what happens to your overall rate of return if the price goes to 48? That's when you lose money. If it goes to 34, you'll make money. Okay. So remember, we started out putting up $2,400. That was our initial equity position. Okay. And we're going to look at it over 1 year. We're going to look at what happens if the stock price is selling at 48. So remember, we had 4,000 by borrowing the shares and selling them. We put up 2,400 of our own money. We had borrowed 100 shares of stock, which originally was at $40, and that left us with an equity position of 24. But what happens if our liability goes to 48? If it goes to 48, that's going to leave our equity position at 1,600. 6,400 minus 4,800 equals 1,600. So if I started out, and you can kind of see, look, if the stock goes from 40 to 48 and you short sold it, you lost about $8 a share. That's the 800 that you're seeing right here. So 1,600 minus 2,400 is the negative 800 divided by 2,400 is a loss of 33.3%. Okay. After all, the stock went up 20%. Short selling is a margin transaction, so it leverages gains, magnifies gains, and magnifies losses. So in here, a 20% increase is going to result in a 33% loss. Now let's look at the good side. What if you short sold and the stock went down? Oops. Uh-oh. All right, so he's gonna get some feedback because my other computer locked up. Just give me a minute. Let me try to reset it.